Hello everyone. In this video, we'll talk about few terms that we frequently encounter while studying any content on value investing or any book on particularly on value investing. So in this video, we'll talk about few of the important terms that are used in value investing literature. So to begin with, the very often the used term is intrinsic value, which I think we have discussed in majority of our previous videos. That intrinsic value is nothing but a fair assessment of a particular business that a shrewd businessman is willing to pay for when he's buying a particular business or a part of it, which is also called as a stock. And I'll read out the content that it is also called as a fair value of a business, which primarily differs from its market price, and that is what Benjamin Graham had mentioned in his book Security Analysis Intelligent Investor, that the intrinsic value or the fair value is not necessarily same as market value, and very often it varies from the market price. And a shrewd businessman or an intelligent investor is one who can find out this mispricing of a particular stock or an equity which is done by the market, and can take advantage of that particular discrepancy in the price. And we have also discussed in majority of our videos that how do we calculate intrinsic value of a particular business or a stock. That is, we can if we can determine its future free cash flows and discount it at a risk adjusted interest rate, then we can arrive at the intrinsic value of a particular stock. So that was about the first part, that is intrinsic value. Second part is margin of safety, and I think that also we have discussed at length in a lot of my previous videos. And it is basically a concept again introduced by Ben Graham, that value investing is all about buying stocks at a fair margin of safety. And what is this margin of safety? It is a process of first you determine the intrinsic value of a stock, and then you buy it at some discount from that particular intrinsic value. And higher the discount, higher is the safety, or higher the margin of safety. So let's say if a stock has an intrinsic value of rupees 100, and if it has current market price of, let's say, 65 or 66, so basically you are buying a stock at two-thirds of its intrinsic value, so you have a margin of safety of 50% in that particular case. So that is what margin of safety was all about. And I think I have discussed a lot about this concept of margin of safety in my most of my previous videos, so you can definitely check out for further details. Now, key point in this particular video is about this permanent capital impairment, and I think it is very much used, and it is very often the most important concept or the most important point that value investors always keep in mind. And it basically happens due to the erosion in the intrinsic value of a stock and results in permanent capital loss. So, for example, if there is some inherent problems in the business which are not temporary but more permanent in nature, so because of that, what happens is usually the price may or may not dip, but then definitely there is a dent in the intrinsic value of that stock. And that is what value investors are very much concerned about, that they don't, so basically they don't pay much attention to the price of a stock, but then they see whether the business is, so if a business is having any trouble, is it of permanent or temporary nature? If it is temporary, then they take advantage of it by getting into the market when the prices have already crashed for that particular stock. But then if there is a permanent, if there is a permanent, as I mentioned, there is a permanent dent in the intrinsic value of a stock, then they do not venture in those particular stocks, even if the price is not an issue for them, because that is something that is going to take that is going to take a hell lot of a time for reverting to its original condition. So that is something value investors have value investors pay a lot of attention to this particular part, which is permanent capital impairment. And also a key point here is that this risk of permanent capital loss is different from the academic measurement of the risk, which we have discussed in in our intrinsic valuation calculation method. And basically what academics or what academicians do is they calculate this risk by using the standard deviation and the beta value of that particular stock. And basically standard deviation is nothing but volatility in the price of a stock, and this is what is there in the capital asset pricing model, also called as CAPM, that you can measure the risk of a particular stock by calculating its standard deviation and also by calculating its beta. So beta is basically the movement of that stock or the volatility of a stock with respect to the market. And as we know that market has a beta value of 1. So if a stock has a beta value of, let's say, 1.5 or 1.6, so it is 50 or 60% more volatile than the market. But then again, this is just a theoretical method, and as I mentioned, academic measurement of risk is defined as the volatility in the price of a stock and is usually measured by standard deviation and beta value. But then the value investors don't pay much attention to this particular academic measurement of risk, which is standard deviation and beta value. But then the only risk, as I mentioned earlier, that the only risk they consider is basically the risk in the if there is a erosion in the inherent business model of or if there is an erosion in the intrinsic value of a business due to some factors which are permanent in nature. So for example, I'll give an example that though I may not take the name. So recently we have seen a lot of we have seen a lot many NBFCs and particularly a very big private sector bank have they have come under the scanner of RBI and all because of the because of the quality of loans that they have given, which have resulted in a lot of high NPAs and all. So people were, especially retail investors, they were just jumping that, the price has now come down from 500 to 300. So let's get into that. What sort of this thing? But then no one really paid much attention to what was happening inside the business, right? And this is what so value investors will never venture it out into such kind of cases wherein they feel like if there is a permanent damage to the business, whatever attractive may the market prices, they're not going to buy into that particular business because it won't be it won't take much to stock price to further crash. So there were many people who said like 500, from 500 has come down to, let's say, 400, from 400 to 300. So how much cheaper it can get, and subsequently it fell down to, I don't know, some 10 rupees or 12 rupees or I don't know, something like that. So in that case, it is basically a permanent loss of capital, and maybe the stock may do better in future, but then it is more of a hope than this thing. So it is not intelligent investing, just to give you an example. And the last point is the value investors, they tend to be variance seekers. So when I say variance seekers, means they don't pay, as I mentioned, they don't pay much attention to this academic measurement of risk, which is the beta and standard deviation value, and instead they take advantage of mispricings in the market or volatility in the market. So we have seen that during the month of so last year in the month of March 2020, with the onset of pandemic and all, and the onset of lockdown and everything, the Nifty or the markets fell from the Nifty in particular fell from, let's say, 12,500 to 7,500 with a 5,000 points in just a matter of time, in just 10 days or 12 days. So one would have, if I do a academic measurement of risk, then one would have said that yes, the markets have fallen so much, so there is a greater risk in investing. But then value investors or great investors in particular, they take advantage of that particular a dip in the overall market, and then they get into the companies which have strong business models, strong franchises, and the various points which I have mentioned in one of my previous videos, that what to look out for when you are investing in a particular business. So those are the few of the things that value investor definitely keep in mind. So just to give you an example, that the last statement that I made, that value investors or the great investors, they tend to be variance seekers. So this table particularly depicts about the returns of the investment partnership that Charlie Munger started in 1962 and wrapped it up in 1975. So basically, this tells us about the overall returns of Munger's partnership vis-a-vis S&P 500, which is a market, and also the alpha or the excess that the investment partnership generated as compared to the market. So if you see that during the course of 14 years, the Munger's partnership had a CAGR of the compounded annual growth rate returns of 19.8% as compared to 4.9% for S&P, and this is about the 14 years that I'm talking about. And they have brutally, defeated the market by 14.9%. So the alpha is 14.9% per year. So understand that what sort of alpha he has generated. That in a market when the markets have only given to the returns of close to 5%, his partnership had given returns close to 20%, and they have beaten by around 15%, so to speak. And this is about the compound CAGR returns, and I'm not going to get into much into average annual returns, because CAGR is more of a it gives more the clear picture about the returns. But then the key point here is that look at the standard deviation of Munger's returns as compared to S&P 500. That his portfolio had a standard deviation of 33% as compared to the S&P 500, which has a standard deviation of 18.5%. So that is what I was trying to say, that even though the returns which his partnership gave was way much superior than what the general market gave, but then that was at the cost of the volatility in the in the volatility in the returns of his funds. And that is what is meant by that. These people, they're not bothered much about the short term volatility, because again, and instead they take advantage of that short term volatility for generating superior returns over the market. So that was the point that I just wanted to highlight for variance part. uh, then apart from that, there are a few basic concepts that I think we all have read and we all have understood also quite well. But then just I'll go through it one by one. So the next point is about the earnings yield, and this is basically nothing but the inverse of P ratio. The very famous, or the the most commonly used ratio in valuation is price to earnings ratio. So if you just invert it, that is instead of price being in numerator, you just bring price in denominator and earnings in numerator. So you will get an earnings yield. And why this ratio is important? Because value investors constantly do a top-down analysis by using this earnings yield ratio. So for example, let's say if the market, or if the Nifty is trading at a P of, let's say, 25, I don't know, currently it is at, I don't know, at 30 or 35, I don't know, but then just consider an hypothetical example for easing out the calculation part, that let's say the Nifty is trading at P of 25. So in that case, what would happen is that it has an earnings yield of, let's say, 4%, right? And currently the fixed income securities, or let's say 10-year government bonds have yield of let's say 6%. So that is the decision that these people make, the value investors or the great investors around the world. And it is not in India, I'm talking globally, that let's say if US markets, the Dow Jones is at, or S&P is at has a P of, let's say, 50. So they have earnings yield of 2%, and there the government, the 10-year or 30-year government securities have yield of 1.2 or 1.3%. So they constantly evaluate this 2% versus 1.3%. But then again, equities have their own risk, that you are not guaranteed a fixed income per se. But then for the 30-year or 10-year G-Secs have they have obligation to pay you out. So again, so these are the so these are the options, or these are the few of the things that value investors consistently evaluate, as in when so basically where to allocate their asset is something that is being decided by using this particular ratio, which is called earnings yield. Or to put it simply, it is just a inverse of price to earnings ratio. Coming to dividend yields, again, a very simple ratio, that how much dividend a company has paid in the last 12 months per se, or maybe the trailing 12 months, or maybe for the particular financial year, and divided by its current market price. So let's say a company like ITC has paid a dividend of close to, I don't know, just I'm making up the figures, let's say 30 rupees. And if the current price is let's say 210 rupees, so the dividend would be roughly around 1 by 7, which is 14%, 14.1, 14.2%. So again, I'm just making out the figures. Dividend yield looks to be very high in this case, but then this is how dividend yield is calculated. So basically, what these investors do is, they, along with that earnings yield ratio, they also take into account this dividend yield, and then see. So let's say if an index has a P of 25, so in that case earnings yield would be 4%, and then it has a dividend yield of, let's say, 1%. So total returns to the shareholders or to the investors in that case would be 5%. That is 4 plus 1%. And then they constantly evaluate this option, that can they get it anything better, more than 5%, by investing in some other emerging economies, or by investing in some other fixed income securities, or so on and so forth. So this is how value investors constantly evaluate their options using these two particular ratios, which is earnings yield and dividend yield. One key thing to be kept in mind for both this earnings yield and dividend yield is that sometimes they may not give a true picture, or they may not give you the right picture that the stocks are really very much valued enough, because dividend yields or price to earnings for that matter is something which can be a, instead of being value instead of adding a value, they can rather be a value destructive, or it can be a value trap. So all these things need to be kept in mind, that the dividend, so how the dividend yield is, so whether the dividend yield is increasing by company paying out more dividends, or the dividend yield has increased because the price of a stock has been brutally hammered. So this is something that we need to keep in mind before just jumping in the market and see that stocks which have a high dividend yield and low P ratio must be very much they are very much value added in nature, and then just go and buy that stock. That is not the case. So because there is no in investing, they say there is no fixed there is no magic formula, there is no one formula that's going to work. So one has to keep all the factors in mind, all the quantitative factors like this, and all the qualitative factors that I've mentioned in most of my previous videos. So basically all those things need to be kept in mind before we go and buy out the business or a particular stock. The third point is diversification. I think again a lot of us know that value investors, many value investors, they practice diversification. And what does it mean is that buying multiple stocks, buying multiple undervalued stocks, to be specific, so as to mitigate the risk. And the reason is that because we don't know that if we have few stocks in our portfolio, then God forbid if anything happens to that particular stock, then maybe the entire portfolio can get brutally hammered. So diversification is again one of the practices that is being followed by value investors. But then I think again, and I'll talk about it later before I cover this point of concentrated investing. So basically what concentrating investing means is just the opposite of diversification, that instead of having, so diversification says that you can have, let's say 25, 30, 35. There is no fixed number per se, but then usually it says 25, 30, 35 stocks you can have it in your portfolio. Whereas the concentrated investing says that you can have your best ideas spread across only through 5 to 10 stocks. So no more than 10 to 12 stocks for that matter. So it is just an opposite of diversification. And one of the key factors of Berkshire Hathaway's success is because of the concentrated investing, which is which has been practiced and pioneered by Warren Buffett and Charlie Munger. And they don't get into this diversification and all, because they think that there are only very few companies which are great, and on top of that there are only few instances when they get undervalued in nature. So you cannot have a pool of, let's say, 50, 60 odd companies and expect that you beat the market, because in that case you are the market. So then that's not going to happen. So one of the key factors for, as I mentioned, for Warren Buffett and Charlie Munger's success is that they focus, their energies, they focus their attention only on the companies they know well, and only buy them when they are available at a significant discount to the intrinsic value, which is also called margin of safety. So like Warren Buffett has said multiple times that their the investment portfolio of Berkshire Hathaway is concentrated heavily on 80% of their assets are concentrated heavily on 5 to 8 stocks, and no more than that. So they are basically the pioneers. They are the they practice this concentrated investing. But then at the same time, one also has to keep in mind that this particular concentrated investing is a double-edged sword. That if so for example, let's say like people like so retail investors for that matter, if we cannot devote time, if he or she cannot devote time for prudent selection, then it is to their advantage that they diversify and mitigate the risk. But then if there is a professional investor, or maybe a person who has inclination towards researching the stock, doing scuttlebutt, the reading the annual reports, financial statements, and so on and so forth. And if that particular person has a confidence and has a firm conviction, then it is to his or her advantage. Then that particular person should follow concentrated investing, and definitely it is going to have a short-term volatility, as we had seen in the previous slide, as compared by the academic measurement of risk. But then over a long period of time, that particular uh, you know that particular portfolio is going to generate superior returns over the market, S&P 500, or in our case, let's say Nifty 50 or Sensex. And the last point before we wrap up this video is that very important point again, and I think again I have mentioned in my videos, that previous videos, that all these investors, great investors, they look for this concept called moat. And what basically moat is, it is nothing but a competitive advantage that a firm has over its competitors. And it is basically all the value investors seek to invest in companies which have durable competitive advantage over a long period of time. That is the sustainable mode. So basically what they are saying is that they don't want to invest in companies which are great for a short period of time, but rather they want to invest in companies which will be great because of many factors, like the product that they make, or the management which is very much prudent in capital allocation, or or some other factors, whatever the factors may be. But then they only invest in companies which would be great, which are great, and which would remain great for a long period of time. So I think all the most of the companies that Berkshire has invested, say for example See's Candies or the Buffalo News, and Washington Post, and other companies as well. So whatever they have invested in the past, they're all the investments were done way back in 1970s and 80s and all. So basically these companies have remained great from capital allocation perspective. So this is what this entire concept is about, that they're not looking to invest in companies which would be great only for a short period of time. And that usually happens, like if particular let's say there are some government regulations which curbs, let's say import from some particular countries, then in that case the domestic companies tend to get impetus, but then that may usually it tends to be very short lived. And then investors usually jump into that, or when the prices have already escalated, and all the optimism has already been incorporated. So this particular concept is not about that. It is about that the companies which have been there for for so many years, and which are going to be great for the times to come as well. So for example, I've already mentioned that Asian Paints could be one of that company in Indian perspective. Hindustan Unilever is another one of the companies that have been there for quite some time. And because of their very business model, and the management that they have, and the capital allocation characteristics that they have, these are the companies which I think one should look for. So, guys, that was for today. And if you have any doubt about any of the point that you have not understood, or if there is anything that I can, if you want that I can elaborate on further, do let me know in the comment section, and I'll be very happy to help you out. So that's all for today, guys. Thank you, and have a nice day.